Who has joined us on the live. Hello, good evening, everyone who has joined us live for the podcast today. And hello, Anubhav again. How
Hi,
are you doing?
I'm good, Puru. Yourself?
I am doing very well, thank you.
Awesome.
So, it has been a hot day, but I can't wait for winters to come back. But I'm sure a lot of people will think differently. Um, so, today's topic is why and how to invest commercial property. And this has been a very common discussion which I've been involved in last 6 to 12 months. So, thought it will be a good idea to talk on this particular topic. So let's get going. I'm sure a lot of people will be listening to these recordings later on. So hopefully the recordings will be available on the YouTube and different channels. So it is a good knowledge source. So Anubhav, let's talk about a little bit of your own commercial journey before we get into a lot of questions which I have prepared, and few of the viewers who know me have messaged me as well. So when did you start your commercial property buying? And I know the answer,
That's
but
a,
I really want that to come out so that people can understand that how your journey has been.
yeah, I guess, look, I mean, the way the whole journey started actually when I was 18 was with the commercial property itself,
Hmm.
actually. Um, I still have the office that that was back in, I think, we're talking late 90s, but
Yep.
that property still exists right now. Still have tenants in the property paying rent. The property is in, of course, not in Australia, in India. Before
Yep.
I came, but I know it makes money from the very first day itself, and
Yep.
that's what sort of got me interested actually in property itself. So when I came to Australia, that bug did not go away. So and the journey continued, and and of course that's through the residential and commercial portfolio that we've built. But my recent purchase in commercial has been with multi tenancies in Australia as well, which I'm
Yep.
holding currently, and that's a great buy as well.
Excellent. So it has been probably your journey of 25 plus years already, uh, starting from that age group. So, any key takeaways for you? Because you've done residential as well, you've done some active projects as well. So, what stands out for you as an investor and the owner of commercial property? If you compare your feeling and experience with different type of assets.
I think it's a different kettle of fish, to be very honest. You need to have a start with a very different mindset itself. The
Yep.
commercial is you got to, for example, your tenants that you have in commercial are actually businesses itself. So you've got to treat them differently to a residential, mom and dad or couple or family that's living in your home. You have to think through what is it that my tenant might need because they're running a business. So it's more of a relationship with your tenant to really understand their viewpoints, to
Yep.
have a long-term tenant in the commercial itself. So that's a big change of how you would treat a commercial versus a residential. And
Yep.
besides that, of course, there are a lot of nuances that go along with commercial as opposed to residential, but there are also quite a bit of familiarities within the two sectors of the real estate.
Yep.
But I think that someone who has the risk appetite and can also carry the commercial well for cash flow as well as growth, they will probably never go back doing residential if they've got the right type of commercials in their portfolio.
Okay, excellent. So let's start by understanding some of the basics. You can hear me okay, everyone, right? Anubhav?
Yes, absolutely.
Okay. Uh, what are the key differences between commercial real estate and other investment properties like residential or agricultural properties, if you have to use them as a comparison?
See, firstly, I think commercial means that you're looking at, like, let's define the definition of commercial, how we are seeing commercial assets. So you've got spaces like office spaces are commercial properties. You've got industrial, which is warehouses usually, which is commercial. All the retail shops that you see around is commercial. Storages is commercial. Let's say if it is commercial for business real estate, then you've also got, things like um, caravan parks, for example, or medical centers, which you can even run a business in, but you could also hold it as a freehold as well as a medical center. We're
Yep.
talking petrol stations as a freehold or a leasehold that people get into usually. So these
Yep.
are the type of different commercials we are talking about, apart from hotels and motels and so forth that people can still own as commercial properties. So
Yep.
typically there is a differentiation between industrial office space and commercial that people want to usually buy. Of
Yep.
course, childcare centers is no different. They're very popular as a commercial properties to buy, or even the entire shopping center for that matter, as opposed to individual retail shops can also come under commercial that people are quite interested depending on the budget that they have. And the beauty
Okay.
with the commercial investment really is that you don't have to spend millions of dollars to buy commercial property. Your commercial can be with a purchase price as small as even half a million, as well, or even lower if you're going for things like a car park, or in a bigger car space that you're buying a
Yep.
small space within a big huge car park area. So you could buy that space as well, which is maybe just $100,000 or a few $100,000 depending on how big the car space is. Or you could buy multiples of
Yep.
those, or you could buy the entire car park building itself, depending on how big the building is.
Okay. And so if I have to sort of break down the types of commercial, um, is it better to break them down by price points, like there is a behavior difference between under $500,000 commercials versus under $1 million versus more than $1 million, or it's metro versus regional versus rural versus remote commercial, or the type of business running in the commercial freehold can make a difference in the experience and the outcomes of the investor. You know what I'm saying? There are different layers to
Yeah,
what I'm hearing from you.
I think what you're describing there is more to do with the risk appetite or where you can get the right type of commercial properties. But the key definition of differences that I mentioned, being industrial versus commercial, is quite clear. Industrial is an
Mm.
industrial shed that we sort of invest into. Storage spaces can also be part of industrial because it is still what you're building. But what you're referring to is actually depending on the price point. If you go for half a million investment in a commercial versus $1 million, you could choose better markets. You could choose a better type of commercial asset style type of a property as well. So if someone has only 300K, you could probably get an office space, but that might not be the best from a growth perspective. As a result, you can get a cash flow. So I compare office space depending on if it's an office space in the entire big huge building like similar to CBDs. We've got office spaces in any central business district of any state. Um,
Yep.
and compare that, with a residential apartments, for example, where the cash flows can be quite high, but you might not see any growth. So a lot of this comes down to risk appetite of a type of property within the commercial or industrial assets that people would want to hold and why, rather than actually saying there is a different classification to it.
Okay. So let's say I am an investor. I have some equity in my principal place of residence. I have not invested any other property. Why should I choose commercial, or why should I not choose commercial, one or the other? So probably the pros and cons is the question.
Yeah. I think the number one thing there is depending on what that equity looks like, you could come up with a determined purchase price that you can look at, especially
Mm.
from your borrowing capacity perspective. Let's say there is about, let's say there's 300K that equity can be tapped into, or you
Yep.
have cash plus equity from your property that can be tapped into, and you can buy
Mm.
up to $1 million, for example. Then
Yep.
clearly, of course, you can, the type of commercials we buy can go up to 75% LVR. So there is doability in terms of the money. So there's no problem with that, right? So that's the check number one, that does my finance even allow me to buy a commercial before you
Mm.
even think of investing into commercial. The second is, if the finance is doable, the borrowing is there, then the next step is that the right thing that my portfolio needs? Now, in your example that you mentioned, You're saying I have my first, I've got my principal place of residence and I don't have any other investment. Is commercial the first one being the right thing to do as opposed to residential? That depends on personal circumstances, to be very honest. Someone who may have a very high risk appetite, they might be on a very high income, or maybe on a very low income but has high risk appetite, and they may want to supplement their low income with a commercial income. Then that is also possible. Now, to give you another example of a commercial, which is a little variable way of looking at it, you could still be in a residential property but achieve commercial outcomes as well, right? And that might be a suitable option as opposed to doing, the typical commercial properties that I mean. What I mean by that is maybe you can go, maybe the person's appetite is medium style and they want
Hmm.
commercial like results that commercial
Hmm.
gives in terms of cash flow, but they might not have the risk appetite to buy a standard retail commercial property. So an alternative to them could be, let's look at Airbnb as an option if you have the appetite for that. So you buy a right residential property close to about 800 to $1 million in a good location, where you can actually really get good tenants to be able to buy, rent that property out as an Airbnb style type of a property, and that can give near to commercial cash flow results for people as well. So it's not one size fits all. You don't have to look at just commercial being an asset class that you really need to do. You could look at creating commercial opportunities from a residential property as well. But let's just say someone has a risk appetite, they're all good, they have the incomes that can support the buying from a borrowing perspective, and it's the very first property that they want to supplement income. And also age group matters. So if they're in the 30s or 40s, I don't recommend going commercial the first one. And it's not to say that you can't. It's just that may not be the right thing to do at the very first property because you haven't even understood how to invest and how to manage your investment properties before you go into commercial. But let's say if someone is in their 50s or 60s and they're doing the very first property after their principal place of residence, my answer is different because at that age group, you're probably not worried too much about growth. You may have already made your money or saved a lot of money, even in SNSF for that matter, you might have the funds. So commercial could make a lot more sense to someone who is really looking to retire and has funds to really invest. So my answer would change depending on age group as well. And again, it's a disclaimer. This is not about providing any advice to any age groups today, but it is to say that, if you just look at the risk appetite versus the need of the hour or what's the immediate need for the next 2 to 3 years, the solutions can be crafted accordingly. Or, another example could be going into a rooming house style type of a property. And that is absolutely phenomenal result as well because it can yield net 8% type of return for someone who has an appetite for co-living type of space. And I think we covered that previously as well of actually renting room by room legally. And different states have different legislations aligned with it, but that can also
Yep.
yield commercial results in a residential sector as well if someone doesn't want to do a typical commercial property just from the risk perspective or perceived risk, I
Makes
should
sense.
say. Yeah.
Makes sense. Okay. So can you hear me okay? Because there was a bit of interruption on my internet. So it depends on the age group, it depends on the risk appetite, it depends on the borrowing capacity and few other things. So is there a borrowing difference, the way you borrow in commercial very different to the way you borrow in residential?
Yes, I think the proposition is based on the type of asset, the risk associated with that asset class, essentially, or is a commercial or is a really a mixed use versus a single tenancy versus multiple tenancy. When I say mixed use, you could have a commercial which is maybe a couple of shops, and then you've got a residential units attached with it, so it could become a resi commercial or a mixed use type of a property. So the risk appetite of the banks are quite different, but um, uh, as opposed to buying storage, for example, a storage might be a lot more riskier seen by the bank, so the LVRs are going to be fairly low as well. The type of retail style type of commercials that we are buying for our clients, we have seen an average LVR of around 75%, quite safely. But I would urge everyone to, when they're looking at even working out a commercial property or they want to own a commercial property, to work out on the LDR numbers of around 70% being on an average. That's probably the right number to look at, which means that there's 30% deposit from your end plus costs or whatever it is to buy the commercial.
So if it's a say $500,000 commercial, you need to have 150,000 in cash or equity, right?
Yes.
And what is the buying cost percentage? Like you're paying stamp duty and all the other due diligence.
I'd
Um,
probably factor 6% of cost to buy, but if you're going to use buyer's agent, then that piece is going to be add on to the overall number.
okay, good. Um, Now, in terms of understanding the lease of a commercial, because from my understanding, when you do your due diligence, the commercial properties can have variable type of leases, and the whole assets value is as good as the lease structure and the type of business which is running there and the location and the relevance of the business for the area where it's running. Is that right?
Yes, so the typical commercial property is all run on lease, right? So lease is everything pretty much. And that's why lease is very bespoke as compared to residential, where residential leases are pretty standard and all you're doing is fill in the blanks and you sort of, what date does it start, end, what is your rent, and most of that whole terms and conditions are pretty much quite standard as per the legislation of the state, and it becomes pretty much standard way to run it for length of the lease, whatever 6 months, 12 months, whatever that might be. Whereas in commercial, it is a very bespoke lease. What that means is you can design the terms and conditions that are suitable to your tenant versus yourself. So a lot of it can be changed the way both parties agree. For example, it's a retail space and it's an empty shell. Now, if it's a restaurant, for example, and a new restaurant comes in to take that place, and they're putting fixtures. So they're going to spend 200, 300K, but then are they going to take the fixtures back after they leave, for example? So that could be negotiated, should you be doing that or should you leave things there? So based on what equipment they're bringing, they may leave back some of it, but you have to agree, put it onto your lease. So it's very clear that what is going to be an exit and entry point. Secondly, even for that matter, how long the lease is going to continue, like what are my options in the lease? So the way the lease is structured is you've got options within the commercial lease. So I could rent something for, let's say I'm a business and I want to buy your commercial, I want to lease your commercial property. I could go in there with a three, or maybe to start with, I might be a new business, so I'm not sure how is this the right area for me to do my business as a retail shop. So let's say I own a clothing shop, and I might just come to you, okay, well, I think this is a prominent place, I like it, and I like to take the lease, but I have a risk to sign long-term lease with you. So I could come back and say, I want to go for 1 year lease with you first, and then I can create options of maybe 3 years and for another 3 years. What that means is then the lease term looks like first year, 1 year plus three plus three. Now, and in technical terms, what that means is my first year is locked in with you, so I'm committing to that. The next two options that I have, which is plus three, I'm not committed, but you are obligated to allow me to continue if I was to continue. So 6 months prior to the existing lease expiring, usually the property managers in commercial would reach out, or the owner of the property would reach out to the tenant, asking if they're going to extend. So you have an upfront understanding of that, and then you can capitalize on the time to advertise that if that tenant is not going to continue, as an example. So that's why I meant to answer your question. It is very, very bespoke. So even if in terms of the outgoings, because in commercial the outgoings are paid by the tenant, whereas in residential most of the outgoings are paid by the owner. So you can even negotiate what outgoings are going to be paid by tenant versus the owner, if at all. And that can also be written down in the lease very clearly so that what they're responsible for.
Okay. And in terms of a normal commercial properties, due diligence, and then contract execution time period, what is the difference between that and a residential transaction?
I think there were three, four questions. Sorry, can we
Yeah.
go one at
So,
a time?
for example, a normal residential buying can take from the time of accepting the offer to settlement around 60 days to 90 days. So, in terms
Yeah.
of commercial, is that the sort of time period which also is similar, or it can be longer?
Yeah, absolutely. It can be longer. It just depends on what's been agreed at the time of the offer.
Okay.
Usually, apart from the building and pest and finance clause, the additional clause that goes on to the commercial offer at the time of buying is due diligence clause, which basically means that a lot of information is unavailable at the time of the offer. So we're going to do that after the contract is signed, as long as the offer, the purchase price is okay for both between the two parties, and the contract gets signed with the due diligence. Now, due diligence can run for 30, 45 days depending on what they've agreed. Sometimes it gets even extended. Sometimes finance, if you've allowed that for maybe 30 days or 15 days, 20 days, because it takes a little longer to get through finance. Sometimes that doesn't work, then you need to extend that further as well. So settlements are usually decided based on unconditional position, at least what we are doing right now. So we decide once the property is unconditional, then 30 days from there would be the settlement date. That's what goes onto the contract as condition, which means that it is open date until we've gone unconditional. We're locking in the settlement date 30 days after that, essentially.
Okay. So, again, there is a bit of difference there as well. That's what I was trying to gauge.
Yeah. But in terms
Uh,
of the length itself, a
mm.
purchase can, right from sourcing to closing, it can take even 6 months as well, because commercial properties are far lesser as compared to residential in the market. It's probably only about 10% of the value of the overall real estate, essentially. So that's why, we're looking at low stock compared to residential properties.
So, low stock and high demand, or it depends on where we are looking?
Yeah, it depends on markets and, of course, timing and the area that you're looking at. There was a
Okay.
point in time in COVID, for example, there was a lot of demand for warehouses in and around the area I live, and then suddenly now, the demand has fizzled. So there's a lot more empty warehouses sitting with a lot oversupply in the same area. So it could, it could depend on timing, essentially, what that means. But yeah, it's absolutely comes down to due diligence of your demand and supply of
Okay.
any real estate for that matter.
So I have a ping of a question regarding, so should we be going for a brand new commercial build on the design sort of investments or established?
Again, it's the question like, do I buy a brand new in residential versus established? I can't see any reason why you can't go established. A lot of people they understand residential new builds very easily. Commercial, firstly,
Mhm.
not many people have even invested in commercial. So starting a brand new to build commercial can be challenging itself, because the architecture doesn't exist in their mind and they don't have the confidence. So I would say, never done commercial before, start with the established ones.
So it depends on what you've done in the past rather
Yeah.
than right or wrong.
Yeah.
Okay. So what are the negative things about commercial? Which are the
Um,
cons of commercial?
Commercial, if you're comparing that with residential specifically, I would say commercial, you have to really think through uh, the the risks associated with the commercial that can be slightly different. For example, location is everything when it comes to commercial, right? So if you buy in the right location, you could be quite confident. For example, let's say I buy a commercial property with a bank in it as my tenant, and let's say it's a retail space and there's bank operating there. We know banks are shutting down their branches, or many of the banks do have that as a strategy to shut down their retail branches and run the show a lot more online. So there's a natural fear of instinct that, why will I buy this asset when that is happening? So, but I think to look beyond that, what is important is, what is that property? Where is that property sitting? Where is the location of the property within that area and suburb? Is it highly dense in terms of the commercial activity in that area? Then you could be quite confident that if the bank leaves, somebody else would take that. So I think that due diligence is really the key part. So that could be negative from the point of view of the type of property you're picking up. The second is that if it can take longer to buy and sell both the commercial properties. So if you're looking to liquidate something very, very quickly, that could definitely work against you because commercials do take time to buy and sell. Third, the lease, can let's say if a tenant is leaving and they're not renewing your lease, then it can take a while before your property can be leased back again. So you have to really understand that you have to build in that 2 to 3 months or maybe even 3 or 4 months of vacant lease if at all that happens in the area. And therefore, some of these risks can be, I think, hedged against the other investments or the type of investments we tend to do for commercial, so that people can feel a lot more confident in buying the commercial properties.
Okay. So thank you. Now, in terms of state-based behaviors of commercial, are there things to consider?
Um, yes, I mean, for example, states do define how stamp duties will impact commercial. So, for example, there is no stamp duty for commercial in South Australia, and I believe that's
Seriously?
also. That's right. Yes. So there's no stamp duty for commercial. Most of the commercial type of properties in South Australia don't have stamp duty at the moment, and that is also true for Canberra. Even regional Victoria, I believe, has got a 50% benefit right now from a stamp duty perspective. So
Mhm.
that could be an incentive for people to buy investment properties or commercial investment properties, and also a big incentive for businesses to basically get in there because all they're trying to do is improve the activity in the area as such. So if the stock is available, of course, there's an opportunity for tenant to come in there, and therefore people want, that any areas government basically is doing this to make sure that it can be incentivized in some form or shape. So that does happen right now. So that could be one sort of difference between the states, but also the legislations and the property management can be aligned with the residential type of legislation in that area. So you have to really know the nuances of what that particular state will bring on board, which is why it is good to work with the right team who knows stuff in different states.
Okay, no, excellent. So there is a perception that commercial doesn't grow as well as residential. Is it a fair perception?
Depends what you buy and where you buy. I would say it is a perception, as you said, not the reality though. If you bought the properties in the right area and the way it works, then commercial can be an absolutely game changer for growth. Actually, talking about that, let's talk about the fundamentals of how commercial grows in value, and then people can
Yeah,
understand that.
yeah,
There's a concept of a cap rate. So what that means is capitalization rate. That's basically an average rate for the area for that type of an asset class in that particular area. So let's say I'm going to buy a retail space, right? And let's say it's $1 million property, for example, right? Let's say the cap rate in the area is 10%. What that means is that that's the going rate for the purchase. So which means that if my cap rate is sitting at 10% and I'm buying it a million, that's the rate I'm looking at right now. Now, if my rent goes up, say, and let's say that $1 million property is achieving me a rent of, say, $100,000. So that's at 10%. So that's what net 10% means, that I'm actually getting $100,000 in rent, which is net. Net means that uh, it's $100,000 in rent plus GST plus outgoings. So that's what it means. So $1 million asset, net 10% yield, which is the cap rate, which means my rent is $100,000 plus GST plus outgoings. So that's what net means in commercial space. Now, let's say tomorrow or after a year, that rent goes up to $120,000, right?
yep,
Which means that my rent's gone up by $20,000 in one after 1 year. It could be
yep,
change of tenancy. It could just mean that it was written into lease that there is a increase in lease, increase in rent every year to CPI, or it could be just that there will be an increase of 120, whichever way the lease is written. But let's say the rent goes up to 120K. Now, if the
yep.
cap rate hasn't changed, which is 10%, right? What do you think is my value of my property now if the rent is $120,000?
Mm, I mean, to my mind, the property is generating more rent, so the value should increase because I'm owning an asset which is giving me higher rental.
Correct.
But
So,
yeah,
so in that term, $120,000 with 10% still at the same cap rate, my new value will be 1.2 million.
oh, so it grows at the same in the same way the rent is increasing.
So it's a simple mathematics formula, right? So you've got same thing as yield is equal to value divided by the cap rate, essentially, right?
Yeah, yeah,
So so if I'm so which is the rent essentially. Now, if I have the rent of 100K and I divide that by the cap rate, I'm going to get my value. Essentially, that's what it is,
got it. That is excellent.
right?
So that means really you can keep on growing as long as the rent is growing as per the inflation CPIs. And then there is a thing of like there are different type of revision like leasing terms as well. It will be good for the viewers to know because from last time I spoke to you, whenever the lease terms are getting redefined, there is a review of the overall position. So like things like 3 plus 3 years, 5 plus 5 years, 10 plus 10 years sort of leasing. So can you throw a bit of light on that as well?
Yeah, I also just want to complete the previous question on growth property. So
Yeah.
that's not the only factor that actually how property grows in value. So if I did not get the formula right and I didn't say that, I'm going to say that one more time. So
Mhm.
value, which is the actual what my value of my property will look like, is equal to the rent divided by the cap rate, right? So I said to figure out the new value, my new rent is 120 from instead of 100, and my cap rate is still 10%. So I get 1.2 million. So that's an increase of $200,000 in 1 year because my rent went up $20,000, right? So
Yep.
that's a simple maths. Second way of how rent your value can go up is if I reduce the cap rate. So let's say from 10%, my cap rate on that particular property becomes 8%,
Hmm.
right? As the denominator is reducing, the value goes up, if that makes sense. So
Yep.
that if the rent
Yep.
hasn't changed, but the cap rate reduces, my value goes up as well. That's how the
Yep.
formula is. What that means
Yep.
is if I can reduce the risk of my property, so let's say I have a space of 100 square meters, right? And that is
Yep.
rented for $100,000 a year that I
Yep.
mentioned, right? Now,
Yep.
if I split that with two different tenants instead of one
Yep.
tenant, right? Not only my rent will be higher than $100,000 because for a smaller space I can charge more, right? Each tenant. I've also reduced the risk as well, but for the overall asset itself. So instead of 10%, my cap rate can come down as well, right? So in the
Understand.
same example, if my rent went up, say 120 because of two different tenancies, and let's say my cap rate, I'm just doing some mathematics, let's say my cap rate comes down to 8%, now my
Yep.
value changes to 1.5 million instead of only 200,000. Now I've got an increase of 500,000,
Yep.
right? So that's how the impact is if I can reduce the risk. And the other way to the risk reduces is what's happening in the market overall. So if it's a gentrifying area, there are changes happening in the area, there is more demand, less supply, more businesses are coming there, more people want to move up there, automatically the risk reduces of the area, right? And that's what the banks
Yep.
will basically run a capitalization rate, or the valuers do that. It's quite an exhaustive valuations that that valuers do. So therefore, the cost of valuation also is quite high when you go to buy something. And as a result, if my cap rate is coming down of that area itself, which is not in my control, but if that is happening, then that is giving us further benefit. So when you're trying to buy a property, you have to look at growth parameters of the area in general, because if residential is going to rise over there, the commercial will follow too as well, because the area is going up, and that helps in growing the value of the property quite significantly. Secondly, the two things that are in my control is the risk of the asset itself. How do I reduce the risk by either multi-tenancy? Maybe I can increase the value of it by increasing the rent, have a longer term of leases as well. So let's say I buy something which is expiring in maybe next year and the lease will expire. That means there is risk next year that this property is not going to be tenanted, right? But the moment I renegotiate the lease with a longer term, for example, instead of that 1 year, at that point in time, if I renegotiate after at the end of first year, I renegotiate that, let's go for a 3 year fixed contract or 5 years option. plus another 2 years of 5 plus 5, then now I have a value on that lease, and that value of the lease is a 15-year positioning with that same tenant. Although he is only obligated to serve his first 5 years, but the next 2 years at least there is an option in place that automatically reduces the risk as well, and that means that I can increase the value of the property as well just by renegotiating the lease the right way as well. Does that make sense? So,
Absolutely.
so there
So,
are a lot of growth parameters in your hands based on what you buy, how you buy, and then I can do that. The second way, also another way, is that if I'm buying a vacant property, for example, right? If I'm buying something that doesn't have any tenant in there, and then I try to lease it after I buy the property, I have also now reduced the risk before I sell it again, for example, with a tenant. So that means I can now reduce the risk, which means now I can, increase the value of the property as well because the risk has come down. So reduce risk, the value goes up. Increase the rent, the value goes up. That's how simple it is. That's all you have to remember.
okay, no, no, makes sense, and I think it is a newer concept for a lot of people. So,
Yeah.
if you are listening for the first time, of course, it will be a little bit of time before they absorb it. So, I have a question from Saurabh, and thanks for the question, Saurabh. The commercial property uh, is generally leased for long time. For example, 3 plus 3 plus 3 years lease. Does it
Yeah.
mean that in order to see higher rental yield, we need to wait, and so does the value increase depends on that? Insight, please.
Yeah, that's a great question, and that also answers your earlier question that I went back on growth in your case
Yeah.
as well. So let's say the first 3 years is being served right now by a tenant, right? I have a new tenant who's starting his first 3 years. So the way the lease would be defined is that okay, you've got the X rent to pay. Let's say
Hmm.
that is $100,000, right? For on $1 million that we talked earlier as an example. Now he is obliged to pay that rent for $100,000 to me, which is the net rent. Now, let's say in the lease, I would have written down that there will be a rental increase for the next 2 years of this lease because it's a 3-year term
Yep.
of 2 years, which will be at CPI level. So what that means is that at least whatever the inflation is, it will cover the inflation. So if the inflation is 4%, then the next year my rent will go up 4%, for example, right? And
Yep.
then that is year number two. Then year number three, the rent will again go up by 4% of the rent in year two, for example. So I can't
Yep.
do anything dramatically to increase the rent in those 3 years, apart from this CPI increase that is automatically going to happen because you've written that in the lease, right?
Yep.
Unless you've got some other fancy arrangements in the lease written down in your first 3 years how the rents will go up. But in most cases, this is what I have seen. Now, when it comes to options, so let's say the first 3 years are over, so your first term is done. Now it's time for renewal, right? Now, as I said earlier, 6 months prior to actually your term finishing, you reach out to the tenant and you ask for, are you going to renew, and give him a fixed time. By this date, I need your confirmation. Otherwise, we are open to go to the market and look for tenants. And that is, pretty much legally as a letter that goes out to them, so they know that that's the date that they have to confirm. Let's say if they do confirm that they're going to do another 3 years, there is a positioning at that point in time when the rents are reviewed based on the market before the new option kicks in, right?
Yep.
So if the market rent at that point in time, let's say, is $150,000, right? And whilst your current rent might be sitting at maybe close to say $130,000, just because you've had some increases as well. I'm just giving a random number
Yep.
for the context to understand this. What that means then is that my new rent in my first option, which is the 3 year, will kick in with 150K. Then the next 2 years of that option, it'll continue at the CPI, and then again there will be a market review before my last option will kick in. That's how it works.
No, very insightful. Thank you. And from a commercial perspective, is it important to consider the license, like the insurances which we buy, are very similar to what we do in residential? Because, for example, if it's a uh, warehouse which is rented out by a chemical storage business versus a restaurant, so in my mind, the type of freehold I'm giving and maintaining can have a very different impact on from insurance perspective.
Yeah, so look, I mean, insurance is always recommended. Have an insurance broker to work this out. Don't try to buy any insurance on internet as it is for commercial because it can be quite a complicated activity. And depending on the nature of the business that the tenant is running and so forth. In general, when the due diligence is done whilst buying the property, one of the things to check really is what insurances do the businesses currently hold, right? So they should really be insured for their activity or what they do, and at the same time, to a large extent, their equipment and everything should also be insured. Now, what is not usually covered in their insurances is that, let's say there's an air conditioning, right? That's obviously most properties will have air conditioning provided by the owner as part of the building,
Yep. Yep.
and something goes wrong in that air conditioning, not because of the fault of the tenant, then
Hmm.
that means that it is not even a maintenance problem. It is something that you need to replace. Now, if that happened because of the fault, not because of the tenant, then you are exposed. You need to have your insurances in place to make sure
Yep.
that that can come. So building insurance is absolutely recommended in that regards. But in most of the other insurances, in my view, should already be with the tenant. If it's not, then they need to take that out. Otherwise, it's an open risk as well. And again, a lot of the insurances, what they can and shouldn't, also depends on legislation and the state as well. For example.
Okay. And is the commercial property management different to residential property management? Are there different costs to
Oh
be
yeah,
associated with?
absolutely. It's
Hmm.
it's a different kettle of fish. I own a property which has got residential tenants with commercial all within the same building. So as I said, I had multiple tenancies in my recent purchase that I did. So
Hmm.
I've got two different, um, property management for that. So residential property manager manages the residential component of of those leases, and
Yep.
then there's a commercial person who manages the commercial aspect of it.
No, thank you so much. And it is very, very insightful information. So we have property management, which has a complexity in itself, insurance, which has its own complexity, and then the due diligence. So definitely, it sounds like it is a fascinating asset to go for, but it is probably more important to consider a good professional support of professionals who understand what they are doing when you're trying to
Correct.
buy these properties.
Yeah. See, there's a lot of fear and stigma attached with commercial in general. And the intention of this particular podcast is to actually get people to think a little bit outside the space, right? Right now, we are the use case right now for commercial people are those who are, have already some residential properties quite heavily negatively geared with today's interest rate positioning that they have. So technically, what happens with them is that they are suffering right now because their lifestyle gets also impacted because of so much portfolio that they have, which is highly negatively geared. Of course, you can do all those things with bank reviews, go get your loans reviewed, your interest rates reviewed with different banks, and see what you can do with all those sort of things and negotiate. Go sell some of the properties you can't hold, and all those sort of things already exist. But the other way to do this also is that think of if you have the capacity to buy and continue to buy, you can supplement some of the negative gearing with the positively geared properties currently, right? And an example that I can quote right now for you, which is again I'll talk about my property a little bit so that people can get the context. My property was is worth $900,000 that I purchased. So they were asking for 950. We bought it for 900,000. It's a whole building, as I said. It's got two commercials. One is a retail space, another is a cafe, and then there are two units on the top, which is residential, and there is one studio at the back as well of the retail space. So there are three residential and two commercial, which means there are five tenants. Now, I have four leases basically spread within the five tenancies essentially, right? Uh, so what that does is it gives me, a comfort around if one leaves, the other four are still there as tenants, paying the bills, and my rent is still coming, not impacted fully. So that's a big one. Secondly, on a $900,000, my net rent is $78,000 on that. So that's a 78,000 plus something. So let's say 79,000 total plus GST plus outgoings. So the outgoings are removed from this calculation, so I can work out my net income coming to me. From the 78,000, I can remove my interest component of my loan, whatever that is sitting at 7.29% right now, and I borrowed around 75% from the bank. So if I remove that part as well, the interest component right now, I am left with $26,000 positively geared in my bank account every year right now. And that's the first year of this relationship with my tenancies. Although they might be in the second, third year of the lease, but the rents will only go up from here, essentially, right? As part of the CPI or maybe the market review, as I mentioned, when the options kick in. So, but this is the starting position of 26,000. Now, the way I've set my loan is for 15 years. So I am paying off the loan completely with this positively geared number that I have, which is 26,000, because I'm not putting any money from my pocket. So the money comes in and all goes into the bank account to pay off my principal as well. So what that means is in 15 years' time, I will have an asset which is completely debt free, right? Number one. Second, the rent that I'm getting right now, which is 78,000, in 15 years, that is likely to be 120 to $130,000, overall between this. And that means that I have an asset with a passive income of 120 to 130K in 15 years, right? For a purchase price of 900K. Now, as these rents are going up, the risks of that area is changing. Residentials are doing phenomenally well. They're growing at a rate of 10% to 12% per annum, at least for the last 3 to 4 years in that area. It's a very strong area that we have purchased in Queensland. So obviously that's going to continue to keep growing. And that means that, the risks of the area will continue to keep reducing. And as a result, we are expecting good growth to happen. And even now, when interest rates will start to come down, suddenly what happens is when interest rates come down, businesses have better strength to go and get leases done. They want longer leases. They have customers who are ready to buy because people can now go and spend money. So businesses are stronger. They do well, which means automatically the commercials do really well when interest rates are lower. And that's what we saw even in COVID when money was just thrown away by the government. A lot of people had the money to splash around and spend money on it. And when they're spending money, the businesses are strong. They're doing really good. And commercial went off the roof essentially during COVID. So we're expecting similar type of an outcome when interest rates go down over the next few months and couple of years before they come down to the normalized number on the cash rate, which we think probably will happen. And that means we are looking to really grow this asset in its own natural way, but also have a positioning of strengthening the leases as we recycle some of the tenants along the year. So a phenomenal, in my opinion, a result with a balanced risk and a long-term play for an asset like that. So I hope that rounds up.
Absolutely. And in simple terms, what I've captured from what you were saying is that by one property in 15 years, a person can achieve modern retirement. Because if I captured your numbers correctly, you said you used around 285,000 to 300,000 to acquire the asset, and the way you were explaining to me that the rent will go up in 15 years time and it's making 27,000 yearly, which helps you to pay the principal off. This is phenomenal. Why wouldn't you
Yeah,
buy commercial? That's what I'm trying to think.
yes, absolutely. And this is what I'm saying. When you have some commercial properties under your belt, you won't go back to residential, right? Because it is that cool when it comes to what you can achieve out of this. But the key point is that what you just mentioned, I want to just make sure that people get the message the right way. Today's value is 78,000, in rent. 15 years later, it's 120, 130, but the value has eroded because of inflation over a period of time. So if you're looking at a 120, 130K passive income in 15 years' time, equivalent value, I mean, in 15 years' time, then it needs to be an equivalent value right now of 120, 130 as well. So let's say today I want to retire and I want 120, 130K today, then I should have an asset that is giving me 120, 130K today itself, which in 15 years' time will align with the new value of the inflation. Do you know what I'm saying? keeping inflation to consideration,
Makes sense.
right?
Makes sense.
Otherwise, that 120, 130K number means nothing because your dollar value is reducing as
Yeah.
well.
Yeah, I understand. I mean, you're being absolutely correct mathematically. I'm talking emotionally. I mean,
Yes.
78, 80,000 itself as a passive income is by no standards less to retire right now for individual or a couple in most societies. But
Yeah.
yeah, very insightful. I'm cognizant of the time, Anubhav. It's already 50 minutes past. Uh,
Yes.
ho- Hopefully, a lot of our listeners have captured good information today, and the live sessions will be posted back on the socials. Please post your questions back on those videos as well. We are happy to take those questions. There are a lot of professionals in our group. I love property. They're very keen to participate and answer to those questions. We really want it to be a knowledge based platform, and the more contributions come from the users and people who are professionals following us, tracking us, it will be very insightful and helpful for everyone.
Yes, thank you, Puru, for having me again. And I think we're encouraging people to take the next step and work things through. Of
Hmm.
course, I can't answer everything. I can run the next 3 days workshop on this commercial. We just got so much to talk about, but I think I've
Hmm.
just given a flavor of, someone who has no idea about commercial to really see how they can see in the light of making good cash flow with growth. Of course, there's inherent risks with commercial, but that is also manageable if you buy the right type of asset in the right area with the right growth aspects to it. So thank you everyone, those who are listening. But it was again lovely to be here again today. Thank you very much, Puru.
Yeah, thank you, everyone. I think my camera has been playing up a lot, but hopefully my audio was okay. But thank you
Yes,
all. Have a good night.
thank you. Bye.